All right, let's just dive right into this explainer and really unpack the data. We need to see if a housing crash is actually happening or if the real story here is much, much bigger than your local real estate market. I know we all hear the rumors, and honestly, we see the panic out there. But today, we're strictly relying on the numbers to uncover what's actually driving this market.
Because, look, to start us off, we absolutely have to tackle the elephant in the room. Are we on the edge of a massive drop in home prices? For the past 5 years, certain corners of the internet have been relentlessly predicting this imminent, catastrophic crash. And it's left a lot of prospective buyers completely frozen on the sidelines, just waiting for a bargain that never seems to arrive. So let's look at the actual data and see if those fears hold any water.
Okay, part 1, the state of home prices. Let's ground ourselves in reality by looking at the hard numbers from June 2026. Now check this out. It's super interesting when you contrast single-family homes with overall inventory, because both are clearly showing positive growth, not a crash. Looking at the latest data, Redfin reports that single-family home prices actually rose by 3% year over year. And meanwhile, the National Association of Realtors data, which looks at all home types, shows a 1.8% increase over the last 12 months. The market is demonstrably moving upward.
To put a real number on this, $440,600. That is the current median price for an existing home in the U.S. This figure is pretty much the ultimate proof that those widespread predictions of a market collapse just haven't materialized. If you've been holding your breath for a sudden, dramatic plunge in home values to finally make your move, this number shows exactly why that strategy might leave you waiting indefinitely.
Moving on to Section 2, debunking the crash myth. Since prices are still climbing, we need to systematically dismantle some of these terrifying headlines you might be reading.
I mean, you've probably seen a headline exactly like this popping up on your feed. Foreclosure filings have surged 21% this year. If you just casually scroll past that, it's totally natural to assume the bottom is falling out of the market, right? It sounds like the early days of 2008 all over again. But context is literally everything in data analysis.
And that context completely shatters the 21% surge narrative. Look at this. In the first half of 2026, we had about 227,000 foreclosures. Now compare that to the actual crash in 2010, 1.65 million. So yeah, 21% is technically an increase, but it's a relatively small jump from an already incredibly low baseline. We are nowhere near the distress levels required to trigger a systemic price collapse.
Here's the real deal. For a true market crash, you need a massive flood of inventory to completely overwhelm demand. But right now, our supply has been totally stagnant at 4.6 months. For prices to plummet, you need desperate sellers vastly outnumbering available buyers. But currently, there are only about 1.56 million homes for sale in the entire U.S. That's virtually unchanged from a year ago. There's just no sudden wave of inventory hitting the market to drag those prices down. So naturally, you're probably thinking, okay, why not just build more homes? If we don't have enough houses to meet demand, the obvious solution seems to be just building our way out of the problem, especially since housing starts have been pretty stable. Well, get this, 350,000. That's roughly how many existing homes are destroyed every single year just by standard house fires. And just to be clear, that's not even counting massive, sweeping wildfires. So while builders are working hard to add new units, a huge chunk of that new construction is literally just replacing inventory that has gone up in smoke. We are fighting an uphill battle just to maintain our current inadequate supply.
All right, Section 3, the true cost of borrowing. Let's pivot away from supply and look at the real pain point for today's market, that 30-year fixed mortgage, which is hovering around a pretty high average of 6.6%.
To really grasp why your mortgage is what it is, you first have to understand the 10-year Treasury note. Basically, this is government debt that currently pays a guaranteed 4.63% annual interest. Before a lender gives you money for a house, they look at what they could earn if they just lent that exact same money to the U.S. government instead. And these two rates, they have been strictly correlated for the past 30 years.
Think about it logically from a bank's perspective. They can get a guaranteed 4.6% return from the government, an entity that can literally print money to pay them back. So why on earth would they lend to you, a home buyer who could lose their job or default on the loan, for anything less? They wouldn't. Because of that inherent risk, the bank requires a premium. That is exactly why your mortgage rate will always float higher than the 10-year Treasury yield.
Which brings us to Section 4, the global domino effect. Let's zoom way out and look at the massive macroeconomic forces that actually drive that 10-year Treasury up or down.
Just look at this timeline.
Back in 2021, the 10-year Treasury was sitting pretty below 2%, which is exactly why buyers were locking in those crazy 3% mortgages. But then 2022 hit and inflation accelerated. As inflation expectations increased, investors demanded higher yields so they wouldn't lose purchasing power. Fast forward to today, the Fed hiked rates, the Treasuries climbed, and the era of 3% money was officially killed.
It's honestly like a giant chain reaction. Step 1, a geopolitical event like the Iran war escalates. Step 2, boom, global energy prices spike. Because higher energy costs mean everything costs more to produce and transport, Step 3 kicks in. Inflation expectations shoot up. And finally, Step 4, when inflation expectations go up, the Treasury yields and your mortgage rates climb right along with them. And sure, maybe a brief pause in a conflict temporarily drops energy prices. But we still have these massive background pressures, like ongoing government money printing and global de-dollarization. Those factors create a persistent inflationary background, which keeps a pretty firm floor on how low rates can realistically go.
Okay, Section 5. What happens next? Let's synthesize all of this for anyone trying to navigate the market in the immediate future.
Look, we don't have a crystal ball, but the direction of that 10-year note entirely depends on mechanical inputs from two key areas: the administration's approach to geopolitics and energy under President Trump, and monetary policy decisions from Fed Chair Kevin Warsh. As neutral observers of the data, it's clear the housing market sits squarely in the hands of these macroeconomic policy choices.
So until we see a huge shift in either those global war dynamics or federal monetary policy, we're kind of stuck. We are range-bound, sitting right between 6% and 7% for the foreseeable future. Unless we see a dramatic de-escalation in global conflicts that just crashes energy prices, or a total 180 in central bank policy, the math dictates that borrowing costs are going to remain relatively high and incredibly sticky.
Ultimately, I want to leave you with this question. Are you prepared to navigate a housing market that's driven more by global conflicts and monetary policy than by the actual supply of homes in your neighborhood? The days of hyper-local housing markets might actually be behind us. If you're waiting for a crash to buy, you are betting against a severe national supply shortage. And if you're waiting for cheap money to return, you're basically betting on global peace and zero inflation. So armed with all this data, how will you adjust your strategy moving forward?